Hi everyone, and welcome to today's afternoon webinar here at TradeStation. It gives me great pleasure to introduce to us, to our webinar crowd, Jeff Town, the VP of Education and Training at Rule 1 Investing. My name is Don Prattle. I'm the Director of Trader Development here at TradeStation, and today we're going to talk about how stock fundamentals can benefit the short-term trader with Jeff Town. Before we turn things over to Jeff, I need to just run through the disclaimer information for you. Our presentation is for educational purposes only. All the symbols and trading ideas that we might discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, but including but not limited to Hong Kong and Japan. Active trading may not be suitable for you because it's not suitable for everybody. And options trading does carry a high degree of risk and may not be suitable for all traders. What we've posted into the chat panel are two pieces of risk disclosure documents that will help describe some of the characteristics and risks of these vehicles. These documents are also available on the TradeStation website. Many of you are going to ask this question, or you may be wondering this already: is this presentation recorded? And the answer is absolutely. We began recording almost 3 minutes ago, and what you'll be able to find this presentation on our YouTube page, the TradeStation YouTube page, or on our video station if you're a TradeStation user. I will post those instructions in the chat panel as things move along through our presentation today. Now, Jeff Town is a fairly well-known presenter in our industry, and you're going to find out why in just a few minutes as we talk about using stock fundamentals for options trading. Jeff, take it away. The floor is yours.
Thank you very much, Don. I appreciate that introduction. I am always very happy to talk to the TradeStation traders. They're very intelligent and beautiful people, I found. And welcome to our class, our webinar, guys, on learning about fundamentals, how to use fundamentals to improve your option trading. Don, thank you so much for that introduction. I think this is my favorite class to teach. We just got back. It's not my favorite place though. I just got back from San Diego, where we taught about 380 people there about investing a little bit. And San Diego was an incredible spot, and I plan on getting back there as soon as I can. I am in my office in the middle of the America, teaching you guys here, but my mind is floating back off to California here. It's other than the fact that I won't get into politics, but things are pretty crazy out there. It's a beautiful place, guys. I am the other thing I want to mention here is that we just got back from before the California trip. We went up to Montreal, where we had 1,800 people, talking to about 1,800 people up there. We feel like we're doing a revolution, like we're creating this revolt to Wall Street. And TradeStation and its clients are very much part of it, whether they know it or not, because our students and TradeStation's clients have chosen to do their own trading and investing. And we just think that's so much smarter. Of course, you need to know what to do and how to do it, but Wall Street just won't ever get you very far, and they'll admit that. 7-8% rate of return is about all they can expect to get you in the mutual fund industry, because that's what the market does, and they are the market. These guys are so big, these mutual fund industries. They have hundreds of stocks, and if you call the market the S&P 500, which obviously has 500 stocks in it, it's no surprise that they can't beat the market. They are the market. So, if 7-8% rate of return is okay for you, great. But for most of us, if we're not making, well into the six figures and have 20 years or more to see that money grow, 7 or 8% doesn't cut it. So just more and more people throughout the country, throughout the world, are deciding, you know what, I'm going to have to learn how to do this myself. And that first thing we do when we talk to people about Rule 1 is just tell them it's not luck and it's not IQ. Everybody can do this. So what we're doing is just bringing a little more knowledge to the table for everybody to be more successful. And in our point of view, less risk. We are all about less risk. Rule 1 is don't lose money. Our disclaimer, just like Don gave you guys from TradeStation, we've got pretty much the same disclaimer. Any stocks or option trades I talk about today are not a recommendation. We do not have a fiduciary responsibility with any of you guys. We'll call this for education and entertainment purposes, just like Jim Cramer does. I don't know how he gets away with that on TV every night, telling everybody buy, 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 sell, sell, sell. You know, it's so very funny to watch him get up there and do all this stuff that, you know, they've put people out of business for in the the SEC and so on. So I don't know how he's got all the right connections, I guess. But of course, we need this disclaimer just to make sure you guys know we're not here telling you what to do. We're hopefully going to teach you some things that will help you improve your trading and your investing. That's what we're all about. So Rule 1, it is from Warren Buffett. Most of you have heard of it. The Rule 1 is don't lose money. And Rule 2 is, the joke is, but we're deadly serious about this, is don't forget rule number 1. Rule number 1, don't lose money. If you manage risk properly, the rewards will come, the profits will come. People get in trouble with having the big loss. Not only does it, really hurt your portfolio and hard to recover, but it's hard on your emotions. It's just so easy to quit at that point. It's like, I can't do this. I've just had this big loss. I'm not lucky. I'm not smart enough. I don't know, So if we can help you keep or avoid that situation, we feel like we've done a big service to you. You've got to be a little patient with profits, but if you just keep from having that big loss, your profits will come. So that's our number 1 message here, is just don't forget rule number 1. So tradition of successful investing is what we are all about. I mean, we aren't inventing most of this stuff. We are simply kind of in this lineage of knowledge that starts back with Ben Graham back in the 20s and 30s. He made over 20% average rate of return through the 30s, through the Depression, and through the 40s, World War II. The guy was a genius. So, we don't have his IQ, but he kind of carved the path out for us through the forest so that we could follow him. And so many of his students, including Warren Buffett, have gone on to do just as good numbers. So you have tons of people on Wall Street telling you you can't do better than the market. If you're doing 10%, that's really awesome, right? Warren Buffett, Ben Graham, and on and on and on, so many people from this school of investing. And I hate to use the word value investing because it really doesn't define us properly, and so many people misuse that term. I've heard Jim Cramer tell us he's a value investor when he's got hundreds and hundreds of stocks. I'll give you a tip on how you can tell a true value investor from a fraud, but here in a minute. But we are all about finding companies on sale and then making money off them, not only through buying the shares when they're on sale, but option trading off of them and making even more money that way. So just want you to know, this has come from a very, very solid line of very brilliant people, and we're just copying them. If any of you guys know the name of Manesh Prabhai, I mean, he just says, I just clone these guys. I just follow. So many of these guys are so good, so smart, huge research departments. I just follow what they're doing. So we have no problem doing the same thing. Now, my brother, Phil, has written a couple best-selling books. He figured out in early 2000, around 2000, number one, people are just getting their butts kicked in the market, right, from the internet bubble bursting. But the people like Warren Buffett, Phil Town, who weren't caught up in the craziness of and the mispricing of stocks in that market back in the internet bubble, realize, God, people just don't know what they're doing, number one. And number two, the light bulb really went on. Phil realized all of us can do this. Now that the internet is here, we're able to get that research, do that research, get that knowledge that all the big brokers had and kept it to themselves. It was a type of tyranny that they had of the knowledge before the internet. I mean, think about this. It was only 20, 25 years ago. You had to pick up the phone and call your broker to find out what the price of your stock was at that moment, or wait for the newspaper to come that day, right? It just wasn't available. So now we've got everything at our fingertips. And so firms like TradeStation and Rule 1 can get this information out to people, and you can be frankly, you can do better than the guys on Wall Street. I mean, there's a reason why Warren Buffett and Charlie Munger and Manish Pabrai and most of the really good big hedge fund guys that are doing what we do here aren't in New York, aren't on Wall Street. It's so easy to get caught up in just the crazy day-to-day emotion of up and down and, you know, the hottest, latest news coming off the wires. No, I mean, that's not the way to beat the market. So we're going to just recommend you guys be patient, take your time, don't watch CNBC all day. That's exactly the opposite of what you should be doing. So the idea here that Phil brought to the table, so to speak, was meaning that you could not only want to invest for profit, but you also want to invest in a way that reflects your values. It's funny that so many people have their money in mutual funds through their 401k or whatever, and that money is in cigarette stocks or war stocks or, who knows? I mean, whatever your values may or may not be, you're probably breaking them by having your money in mutual funds, because the mutual fund guys have your money in everything. So you're sitting there really kind of getting rewarded from some companies doing something that you don't like, right? They're doing something that, I don't know, polluting a river or whatever. And you're being rewarded if that stock goes up. You want the stock to go up, obviously, but you don't want that company to be successful in the bad thing it's doing, right? So there's this conflict. So Phil really kind of beats that drum of put your money where your mouth is, where your heart is. Put it to work in a good, positive way. And one of the things we've got to change is how these board of directors are operating, because they're just green lighting just about anything the CEO wants to do. They're almost like puppets, so many of them. And we can, as shareholders, vote for the board of directors. The only way we can really have an effect on the way these companies are run and get some of these incredibly insane CEO salaries down and so on is vote for the right people that make up that board of directors, who can then put people, at least have some kind of common sense about the salaries and how the company goes about doing its business. So that's what Phil really brought in his books. First book was in 2005, Rule 1, laying out how you analyze a company. Payback Time came along in 2009 after the crash and just said, there's other ways to value companies, simple ways. Here they are. He didn't talk a whole lot about options, but we're going to talk about quite a bit today. But there's a foundation that I need to lay for you guys about the fundamentals, about analyzing a company before we can jump into the option side of things. I mentioned that there's this school of investing that Warren Buffett is kind of the grandfather of. He and Charlie Munger, his partner. But you can look at these guys. This information came off of Guru Focus, pretty good website. And it shows you, what the results have been for, not the results actually, but some of the details about each of these money managers, mostly are hedge funds. And it doesn't tell you actually what kind of rate of return they've gotten, but it tells you what stocks they're in. and they have to disclose that. So if you'll notice here, you maybe can't see. I wonder if I can blow this up. I'm a little afraid to blow it up. I might actually blow everything up here. But if you can see that, you can see how much, for instance, Bill Ackman has about $6 billion there under management, just about $1 billion for Bruce Berkowitz, 150 billion for Warren. Manish Prabrai, he's actually way closer to $1 billion now. This slide's a little bit old. Okay, so these guys are dealing with real money. But look how many stocks they have. 8 stocks. Einhorn, 33. Julian, 40. I mean, they're all under 100. And I can tell you this, so many of the stocks they have, they don't have that big of a percentage of their money in them. You look at the breakdown of where most of their money is, most of them are in probably 10 companies or less. So the whole idea of diversification is not what we do. And Warren Buffett is kind of brutal about it, but he basically says that's for people who don't know what they're doing, right? That you got to spread all this money all across all these industries and all these companies, because the truth is that that's the only way these guys can keep their jobs. It's not that they're stupid, the money managers. They know that if they don't put the money in the market, first of all, they're going to get fired. So even though they know, man, the market's really overpriced, they put the money in the market because that's what their investors, their rather ignorant investors, expect them to do. And they've got to stay up. Their rate of return has to stay up with the market. If they have a year where they're less, maybe quite a bit less than how the market did that year, they could get fired. So they learn not to be a hero, not go out there and try to make a lot of money for their investors. They learn to just stay with the herd, just stay in there close to where the market is, and they can keep their 7-figure salaries. All right, so that's your money management in the mutual fund industry, in the Wall Street world. But these guys are outside of that world, and they can do pretty much whatever they want because they're hedge fund managers, and they have a lot of power within their fund. They've got a big name. No one's going to fire them. So they can do what they know they should do. And so their rate of returns are all above 15% per year over the last 10, 20, 30 years on average. So they just kick the butts of the money managers on Wall Street. And the only argument that Wall Street has is, well, these guys are lucky. There's some people that are going to get lucky. Or their other argument is, oh, well, look at all the risk they're taking. And Bruce Berkowitz is has a famous track record in that throughout the 90s he did really well, and 2000s, and he had a year or two bad years. In other words, mark to market at the end of the year, his rate of return was well below the market, like 30% loss on paper. And that's because he was buying up all these companies that were going down after 2008 and 9. He started buying them, and they still kept going down a ways. And so he had a bad year or two on his track record, but man, it came flying back, right? And he didn't actually lose money in those years. It was just on paper that he was losing money, but people bailed. And people were like, hey, see there, these big shots that are getting all these rates of returns, look at the kind of money that they can lose of yours if you don't watch out. And you know what? If you're going to be a Rule 1 type investor, you got to be okay with your account going down on paper. Warren Buffett has a famous analogy. He says, if you're buying Dairy Queen burgers, and he always uses Dairy Queen because he owns Dairy Queen, he says, you guys, what do you want the price to do? You want it to go up or down on Dairy Queen burgers? You're a consumer, right? You want the price to go down. Well, we're consumers of stock shares, and we have kind of a long-term point of view. And as a consumer, if we're managing our money properly, we want the market to go down until we've got our full allotment of shares that we want. So we're not unhappy with a paper loss, a drawdown. Doesn't bother us at all, as long as we have that understanding that in the long run, this company is going to go up. And guess what? Nobody can fire us. So that's one of the beauties of being your own investor. But also notice, that these guys don't have a lot of turnover of of their shares. They're not buying and selling, buying and selling. It's not a short hold. That's a long-term hold. And so that's really helps them stand out from the herd. They're putting their money into a few companies, and they're not turning those over very often. They're holding on, waiting for that company to come back. Usually there's some kind of event that is involved in a stock price of a wonderful, great company going down. And I'll use the analogy, or not the analogy, the example of Chipotle Grill. Of an accident happens, people get afraid, they leave. But this is not just on companies like Chipotle Grill. Walmart had a situation, remember back a few years ago, where the Mexican government accused them of bribing government officials. Probably, I don't know the details, was maybe for trying to get companies built in certain areas, or stores built in certain areas. But that scared the market, and it dropped from about 70 down to about $50. And we picked up shares, as we saw that this thing was on sale around $50, we started buying shares. So great big companies can have events that take place. And so we think of ourselves as event-driven value investors. Those two things go together pretty well. Okay, so that's a little bit about our background. What do I mean by a wonderful stock? What does it mean to be a solid, good long-term investment? When we're thinking about companies, we're thinking about a business, not a stock. We don't think of ourselves as stock traders. We're thinking of ourselves as buyers of a few businesses. And we got to look at that company as a business and how is it doing. And you don't have to know that much about business to be able to get a good sense of how this company's doing just from your day-to-day life. So certainty is a word that we don't toss around lightly. Of course, there's no 100% guaranteed certainty in the world, period. Any company could have something terrible happen to it. But we want to get that. It's actually a type of emotion or feeling, physical feeling that you get in your body when you've done enough research and you realize, okay, I'm really certain, and here's the catch. I'm really certain that this company's going to be here 10 years from now, and it's going to be bigger and better than it is today. That's what we're shooting for. All right, and so there isn't. I can't tell you, oh, you got to do 5 hours or 20 hours of research on a company. All I can tell you is that you'll know when you get there that you know enough about this company that you can feel good about its long-term prospects. Okay, so yeah, it takes some work, it takes some research, it takes some time, but getting to know a company is the key to so much about what we do. Now, you remember, we're not going to get into a ton of companies. We're 4 or 5 companies, 6 companies is all we need to really have in our watch list that we've done our homework on for the rest of our life. And then we are not only buying those shares when they go on sale, right? We got to be able to value that company, know when it's on sale, when it's at a good price. But we also do a lot of option tradings. Most of what we do are option trading on those companies. And so it's the basis of all of our strategies here. And it's well worth it. I mean, if you can double or triple your rate of return because you're doing trades and investing on these few companies you've done your homework on, then I think you'd probably realize that the amount of hours you put into it are worth it. You're getting paid pretty well for that research. So what is a wonderful business? Well, it's simply one that we understand. Don't be diving into some pharmaceutical company. You don't know anything about drugs or the pharmacy business. It'll take you a long, long time, and you may never be able to really understand that industry or those companies. So stay away from industries you don't understand. Right? We gotta be able to understand it. That's the number one thing that Charlie Munger says people need to be able to do is understand the stock or the company, the business that they're investing in. And when we understand it, we'll have a pretty good idea that they've got some competitive advantage over their competition. For it to be wonderful in our point of view, it has to have some advantage that's going to protect its customers and its profits from the competition. It's a tough competitive world out there, right? And that's where you see businesses get in trouble is they lose that advantage Maybe they never had one, but if they had one and they start losing it, then it's time for us to head for the doors. And we want it to be durable. We want it to know, okay, that's a great advantage, and it'll be here for another 10 or 20 years. So we'll talk about moat here in a few minutes. It's a real key concept to what we do. It's run by passionate, honest people. In other words, management has to be good. Maybe I should put it a different way. Management can't be bad. And there's a lot of bad management out there. We were just watching a company called Chicago Bridge and Iron, CBI, and it's, had a CEO there that's just really screwed up in the last few years. And Phil, actually, my brother, knew a guy who he hung out with quite a bit. And, he was wasting a lot of corporate money, flying around on jets, going out on these excursions and stuff, and taking, of course, his board of directors people with him and pimping them up. And I don't know, that's not the right word, pimping. But, making them very happy, which, of course, they're going to vote properly when it comes time to raise his salary or whatever. So that's the way the game is played by a lot of people, and we really don't like those kind of CEOs. We're looking for someone who's really more of a hero type of, somebody who really wants to lead, somebody who wants to make a change in the world. So John Mackey of Whole Foods, the Costco guy whose name I can't remember right now, the Steve Jobs, who's not with us anymore, but guys like that can push their employees in a way that they really do incredible things. And it may be the product might not be incredible, it might be widgets, right? But they're out there beating the competition, beating the pants off the competition. Those are the kind of management people we're looking for. It needs to be, we need to understand it, that's meaning. It needs to have a competitive advantage, that's moat, and it needs to have good management. Okay, so that's what we call 3 of the 4 M's, meaning, moat, and management. The 4th M is margin of safety. Okay, 4th is margin of safety. In other words, we want to be able to buy this thing at a really good price so that just in case we're wrong about some things, we're still going to be okay, right? We want to buy it at a good discount so that, because we're not geniuses, if we can get that thing at a good discount at the right time, we know that in the long run, and I'm talking 10 years here, we're going to be just fine. So attractive price is a pretty critical thing that we do, and of course, to get an attractive price, you have to know what it's worth. So I'll talk a little bit about value in a company. So meaning, can we understand it? Moat, does it have a competitive advantage? There's 5 moats. This is what Phil talked about in his first book. From his point of view, there's 5 really good competitive advantages. One is have a great brand. Have a brand that people come and buy your stuff because your brand is so good. They know that they'll be happy each time they come to your store or buy your product. And that part of that is having a good product. Part of it is brainwashing, right? Good marketing or whatever. But having a great brand is really a great advantage over your competition. Secrets, something like patents, right? That or just maybe like Coca-Cola has a secret formula, right? So something that people can't copy because they either can't figure it out or it's against the law. So that's a nice moat. Switching, think of like Microsoft is a good switching moat. Toll moat is like a monopoly, basically. The railroads, utilities, companies like that have basically monopolies. And then price moat, where you've got the lowest price because you got the lowest cost of goods, really, right? Walmart is a company that's just can get better prices, buy their stuff cheaper than everybody else. And so if you want to have a price war with Walmart, good luck. Management, are they honest, passionate? Are they shareholder-oriented? Do they know who they work for? And then margin of safety, what's the fair value? And therefore, once we know the fair value, we'll know what the on-sale price is. So I'm going to go through this a little quick, guys. The idea of what each of these four M's are, because I just went over quite a bit of information just now, and we are limited on time. But meaning is, in a way, we think of it, we're building a story around this company. And that story will help us really get to that level of certainty. So we need to be able to explain what the meaning and the moat and something about management, if to our spouse or to investment partner or whoever. We can be able, once we have enough research on this company, we know how to explain this to people about why it's such a great company. But don't forget, when you do this, that you need to invert the story. You need to be able to look at why this story isn't right, why there might be a problem. What could come out of the closet and get you? You know, you really got to eliminate that buyer's bias, the where you've got the rosy colored glasses on that prevents you from seeing maybe some problems that are there that you don't see because you don't want to see them. So we really emphasize the inversion when we think about a company and its story. Just a quick little acronym trick here to remember what we got to do. R for rulers is radar. Where did you find this company, and how did it get on your radar? Do you understand it? Do you love something about it? Maybe it's the management, maybe it's the product, maybe it's the corporate culture, the moat. There's something you need to really be lit up about. Why is this business on sale? What's the event that drove it on sale? And then we like to think of, once we've bought shares in a company, even before we bought shares in a company, we're reducing basis. And we can do that with a Rule 1 put and a Rule 1 call, dividends and buybacks. So you might want to write that down. Rule 1 put, Rule 1 call. This is our own little acronym here for what we do. We'll get to that in just a minute about what a Rule 1 put is. And then S is for story. We want to wrap this all up in our human brains. Human brains work well putting things into a story so that we can really get a good overall picture about this company. Warren Buffett says you don't have to be an expert. So thank God, right? Most of us are not as smart as the people running these big hedge funds, but you don't have to be. It's not an IQ game. You just need to be able to understand a few simple companies very, very well. Charlie Munger likes to say, we're looking to jump over a 6-inch bar when we're looking for companies to invest in, as opposed to a 6-foot bar, right? Don't pick a hard company for yourself to understand. Pick an easy one that you know, you understand it well, and you know it will be here 10 years from now. So one of the things we like to do is go over to Seeking Alpha. Maybe some of you guys know this website, and it helps us do some research on it. Everybody's got an opinion there, and it's, you know, some of them are stupid, but they do a lot of digging. These kind of amateur and sometimes professional analysts do a lot of digging for us. And so it's a good place to go out, find some fundamentals on a company that maybe we wouldn't have found on our own. So you're weeding through the articles on the company that you're looking at, and just looking for good information about that company or that industry. And you may or may not agree with that person's opinion. Usually, you know, if their opinion is that in the short term this company stinks, well, that doesn't bother me. I want to know about the long term. In fact, if it stinks right now, it might be exactly the kind of company I'm looking for, because I want a company that's got an event going on, some kind of problem, right? Chipotle Grill went through its E. coli problem. It's not all the way through it. So the stock dropped from what, 700 to 400 bucks or something, and that, you know, it didn't get low enough for us, unfortunately, for us to really load up and buy a lot of shares. But we did a lot of trading on Chipotle as it's been banging around 400 bucks. Now it's back heading towards 500, but you know, we're looking for those kind of events. Guru Focus, as I mentioned, is another good spot to go get some fundamental information, not just about the company. They also have analysts kind of writing about particular companies, but to see what gurus are out there buying shares. They have to disclose what they're buying and selling. So why not, you know, if they're our type of money manager, why not take a look at what they're doing? Maybe you'll come up with some good ideas there. How do we know a stock is mispriced? Well, here's kind of the thicker part of my talk, and I'm not, again, spend a whole lot of time on it, but there's something called efficient market hypothesis or theory. Efficient market theory is also how it's called sometimes. But it really in the 70s, 80s, and to today still, it's the main thing that's taught in the business schools. And the bottom line is value and price are the same thing. That the market pretty much has everything priced properly at all times. Now, of course, that helps a money manager who's getting money every month from, 401k money coming in from pension plans, wherever, that they have to put to work. And if they didn't believe that, price and value were pretty much the same thing, then they wouldn't be able to be putting their stock or their money into much of the market right now, because so much of the market's way overpriced, these high PE ratios. So we don't subscribe to this, nor does Warren Buffett, nor does this gentleman, Robert Shiller. Dr. Shiller is, we think, the antidote to this kind of, the paradigm. Let's just say the paradigm is incorrect in schools. And it's probably going to take most of those guys that came up with the concept of the efficient market theory to die and go away, because as we've seen in science or economics, that people get caught up in this thing for their whole lives. They've spent their life proving something. They don't want to hear that it's wrong. But Shiller came along and said, no, it's wrong. And he lays out a great case. And just know that Warren Buffett and all these guys that make these great rates of return also subscribe to the idea that the market does misprice things, that the value and price aren't the same thing. And we like to say, when Mr. Market goes off his meds, that is, kind of becomes irrational through some fear or greed, extra fear, markets can really get temporarily skewed, and that's when we can really make a lot of money. We're taking advantage of that. Warren Buffett says he hopes the schools keep teaching efficient market theory, because that's why he can make so much money. So he says price is what you pay, value is what you get. All right, so we are going to dive in a little bit now into our toolbox. We call it the toolbox, where we, on our website, have built these great tools to help us quickly analyze a company, look at the past, figure out how has it done in the past, and then doing research in various ways to help kind of figure out what the future might look like. Nobody can tell the future all the time, but we do the best we can to kind of get a glimpse of what the future might be looking like for instance, a company like Whole Foods, right? Things change. They had a great run for 10 or 20 years here, and so, but things are changing. They're getting more competition. Can we still kind of figure out where this company might be 10 years from now? Is it going to be one of the winners of the kind of organic food revolution that's been going on here for a while? So we have this tool, this page that we call our Rule 1 Numbers page, and we do the work for you, figuring out the growth rates and the return on rates for these different companies in their past. Let me see if I can use my little tool here. So you can see we've got a 10-year and a 7 and a 5 and a 3 and a 1. And so we do the growth rate for you for these different categories: book value or equity, earnings, cash, operating cash, and sales. We call those the big 4 growth numbers. And they're all kind of different ways of looking at profit, right? But we want to see how is this company done in these different time periods. And then we give it a scoring system, and that scoring system helps us determine at least one way of determining, can this company continue to keep doing what it's doing? All right, and then we have ROE, ROIC, which is return on rates, and that's also a critical part of how has this company been doing in the past, and can we expect it to continue in the future? We don't like trading stocks. We are buying businesses, which is why we're just doing a few companies and why we're doing options on just a few companies. So the 4 M's are kind of the way we look at a company, right? Meaning, moat, management, margin of safety, that we're looking through the lens of the 4 M's. It helps us identify companies that we can feel good about buying and holding or doing short-term trades on. All right, so between our basic understanding of trading, or I should say technical analysis, as well as our fundamentals that we're bringing to the table here, we feel that's the best way to do short-term trading. So due diligence, another word for research, you know, get in there, dig in, find out what is this company all about? What's my point of view over the next few years, what this company's going to do, whether it's going up or down, okay? So here's an example of Whole Foods. If you've been paying attention to Whole Foods, they started you know, it wasn't that long ago, they were up there at 60 bucks. And then earnings started going down and the market started selling off their shares. And down, down, down it went, and then we got a pretty good floor down here around 27, 28 bucks. And do you think that if you had the understanding that this company, number one, was worth 27 bucks on sale, it was worth 50 bucks really, and that you could get it for half price here at about 27 bucks, 25 bucks, and that certain gurus were buying it and buying the shares around that price as well, thus putting in a pretty good floor here, that would be a good way to do some option trading, right? To know that, hey, I could do a credit spread, or I could sell and they could put it at certain prices and be extra safe in my trade. And that's what we're looking to do. Looking deep into a company like Whole Foods, and then watching it and putting the floors and ceilings in there and making trades based on the chart as well as the fundamentals. Okay? So right now, this is not the latest price, by the way, but this is where I was doing very well with Whole Foods for the last year, because they had a very nice, what we call a channel, right, of between 34 or so, 35 and 28.7. You could do pretty well. So as it hits that ceiling and then starts coming down, you could do a bear call spread. And if you were down here, can't write it down there, but because it's the bottom of the page, but you could do a bull put spread. And I won't go into too much about credit spreads. I'm going to assume that you guys know something about that, but that would be one of the option strategies we're doing. Okay, so understanding the markets. Be careful, or I'm sorry, be fearful when others are greedy, and be greedy when others are fearful. That's what we're doing. We want to buy low, sell high. Well, you got to be buying low when everybody else is selling. And you got to be selling high when everybody's buying, everybody's greedy, right? So it's not rocket science, but there's a certain emotion that you've got to deal with that most people don't know how to deal with, that the greed and fear genes, right? And want to be with the herd. So that we have a lot of little tricks that we pull on ourselves to keep from getting caught up in those basic human emotions. Okay, so the valuing of company. Again, I won't spend a lot of time on this. Our toolbox is a very good tool. It helps us value a company in two different ways. One we call the margin of safety, or sticker price. Well, the sticker price is what we'd say is fair value. The margin of safety is on sale by 50%. We're looking to buy stuff that's about half of its fair value. So you might call the 1291 here fair value or sticker price. Okay, and so if we can get it on sale, great. Well, obviously now Whole Foods is up around 36 or so. It's coming down a little bit, but right now it's about 36 bucks. And I've been selling calls because I bought shares back when it was down under 30. But this is obviously not a time we could buy those shares based on our margin of safety price, our calculation, which is a discounted cash flow model. All right, and so the other way we value a company is called payback time, and it's very much based on cash flow. How much money per share are they making in real cash? And this valuation system comes out a little better for us, where we could be buying the stock around 26 bucks based on payback time. That's a different way to value the company. Phil wrote about it in his second book, and so if you wanted to kind of get into the details of that, you might look at for his second book. But this is the critical thing to know about these two different valuation systems. Margin of safety is very much based on the future growth rate that we give the company. We come up with a growth rate we think it's going to be able to grow at going forward, trying to be somewhat on the conservative side. And so that would be determining our margin of safety price. Okay, that's going to help us determine that's a price that we would buy a stock at. Well, if it's got a low growth rate, it's not going to be a very good margin of safety price. It's going to be low. But the payback time might be very high. Payback time is not so much based on the growth rate, it's based on cash flow, based on how much cash is coming in. So a company that's big and maybe not growing as big as fast as it used to be could be making a lot of money and could end up having a more, I would call it, accurate payback time or on sale price, right? So we would say, okay, buy the stock at either $6.49 or $25.83. Both are of value. There's different kinds of companies. These valuation systems help us figure out the proper valuation for different kinds of companies. You got the big companies making a lot of money. You got the typically a little smaller companies growing fast, maybe not making as much money. And so we end up with two different numbers. Both are correct for certain kinds of companies. So this is where we would come up with maybe a buy price on Whole Foods at 26 bucks. Again, for educational, and there's a lot to know behind that number. So don't just go out and start buying Whole Foods if they get to 26 bucks. And oh, by the way, you don't have to wait for them to get 26 bucks to start making money on them. We're going to show you how to start selling puts on these things so that on companies like this, so you can start making money even when it's maybe up around 30 bucks or so, well above, maybe 20% higher than where you would buy the company's stock because you're buying it on sale. So that's a quick primer on our valuation system. Again, we're just using the human emotion, where events create fear, and fear drives a stock price. Often the event often drives the earnings down as well, just like on Whole Foods. So it's driving the earnings down. That makes people fearful. They start dumping the stock, down it goes, and now you get at some point a chance, because usually the fear drives the stock price well below what it's really worth. And eventually Mr. Market comes back, gets on their meds, we like to say, gets back to being rational, and the stock price starts going up. So we're using this emotion that's out there in the markets that people on Wall Street will try to tell you don't really exist, but we know that those are human beings pushing that button to buy and sell stuff. All right, going to zip on here into the Rule 1 put. The Rule 1 put is based on a wonderful company. That's why we call it a Rule 1 put. You're doing it on a wonderful company that is close to being on sale, if not on sale. And we know that we would be happy to own those shares at that price that we'll collect them at, right? When you sell a put, you're obligated to buy shares at the strike price. So if you can get a situation where you're happy to own those shares at that strike price, then that thing that most traders would say is a bad thing, I don't want those shares, I'm going to have to get out of this option trade. I sold a put, the stock price is coming down, I got to get out. I don't want those shares, I don't know anything about this company, right? So that would be a bad thing for a typical option trader. For us, it's a great thing. Somebody's paid us a premium, somebody's paid us some money to make us do what we want to do anyway. So if you can have that situation where you're buying a company you want to have at the price you want to have it at, and somebody's paying you some premium to be obligated to do that, you're in nirvana. There's only two things that are going to happen. You're either going to get the shares you want at the price you want them at, or it's going to expire out of the money, that contract's going to expire out of the money, and you're going to keep your premium and make a nice rate of return in a short period of time on that trade. So it's a win-win situation. Those are pretty hard to come by. And that's why doing your homework on the fundamentals of a company are so important to really understand, to set up this trade, this Rule 1 put. Okay, so when we sell puts, we just have to know, what price we're going to own them at, and then then we can go out and sell whatever strike price is in that neighborhood, and pick up some premium, and we don't care whether the stock price goes up or down. It's a win-win situation. So this is a little bit of redundancy here in my little slide, which has got a lot of words on it, but again, this is recorded. You guys can go back, or you could do a print screenshot deal here, and whoops, let me go back there, and just so you guys can see this, and pick up on this concept. Such a powerful concept about how to marry options and stock option or fundamental stock investing. Really powerful. Okay, going to jump on into the next couple concepts here real quick. Going to go through now. I hope I've built the basis for you to understand what we call a Rule 1 put. One of the things that you have to be able to do when you're analyzing which kind of put to sell, let's say you've decided you're going to sell puts on Whole Foods, and it's easy enough then, once you've figured out where you want to own those shares, to know what strike price which strike prices will get you those shares at the price you want them at. But there's another side of this. If it expires out of the money, you don't get those shares, but you had to put quite a bit of money up, right? Your broker, TradeStation's going to hold a certain amount of money in your account while you have that trade on, because you have an obligation to buy those shares at the strike price. So if that's the case, then that money's held for however long the trade lasts. Might be 30 days, might be 6 months, but it's going to wrap up that money for a while. So if it expires out of the money, you got to know that you did a good thing putting that money to work, that you got a good rate of return on it. And so we call what we use to figure that out is the annual return on risk capital. We call it ARORC, annualized return on risk capital, to figure out, did we put our money to work well enough? Okay, so an example of this real quick is the stock's trading at 29 bucks. You're happy to own it around 25, 26, because your valuation on this tells you it's worth 50 bucks or more. So what do? What can you do? Well, you can't really buy the stock at 29 bucks because it's not down to where you really want to own it at, which is half off. But what if you could sell a $27 put, and let's say you pick up a dollar premium, and there's 60 days left in the contract. And so if you get put these shares, right? If it gets assigned to you, you own these shares basically at 27 minus $1 is 26 bucks. That's your cost basis, we would call that. And so to figure out ARORC, if you don't get assigned those shares, did you do okay with wrapping up about $2,600, right, or per contract, or $26 per share for those 60 days? And so our quick little calculation would help you figure out, yeah, well, $1 divided by $26 is 3.8%. So that's my return on risk capital. My multiplier to figure out time is just simply 365 days in a year divided by 60 days equals a multiplier of 6. In other words, there's 6 60-day periods in a year. If I did this 6 times over the next year, I'd have 3.8% times 6. I'd have a 23% ARORC, annualized return on risk capital, right? So we could do this trade and not care whether we get put the shares, or if maybe 60 days from now we do it again, and over the course of a year we end up with being able to make a 23% rate of return on that $2,600 per contract, or $26 per share. So that's how we would help determine whether this selling this $27 strike is a good deal for us in both cases, both ways, both goals. All right, let me just jump into not only a Rule 1 put, but a Rule 1 call, because once you own shares, guess what? You've got a covered call that you can sell, right? And that that's also a very powerful way to make money short term. So as I said earlier, we've got two goals. One is to own those shares at the buy price, and at our buy price, at our on sale price. And number two goal is 20% rate of return or better. And most of us actually try to get 30% on an ARORC. I mean on a 30% ARORC on our companies that we're selling puts on or selling calls. All right, so the Whole Foods picture, the example here, guys, this is from a little while ago, March 13th, but I think it's a useful example to show you how we would do this. And we typically try to trade things at the mark, the price that's right between the bid and the ask, because we find that the market makers usually will take our offer at something a little better for us than what they're offering. So we typically put our limit order in there at the mark. And let's just, so at this point, the May contract, which just expired, had 67 days left in it, and the stock was trading about 29 bucks. Right, so looking at the strike price here around $27, we could see that with not $1, but 76 cents, getting close enough to our buy price that we could go ahead and pull the trigger on a trade, perhaps. And so we would have done something like that to pull in some good profit without really any risk, is the way we would look at that. As long as you feel real good about that company. Now, covered calls, once you own the shares, you can carefully start selling calls to, again, collect premium. And if it gets called away and you make a profit on those shares, okay. I'd rather not get called away. I'd rather own the shares for the next 5 years and double my money and or better and all that. But if you get shares called away at a strike price that you sold them at, it makes you a nice quick profit. Well, that's not a bad plan B. So we will often sell calls to collect profits. One of the things we're going to try to do is lower our cost basis on this stock so that, in a sense, we're making a nice rate of return collecting these premiums. But wouldn't it be nice to, let's say you buy shares at 26 bucks and you end up owning that company for the next 5 years. Wouldn't it be nice, let's say 5 years from now, to have pulled out $25, $26 worth of premiums and maybe some dividends gets sent to you and so on, to where you can say, you know what, I've gotten all my $26 a share back. And I've taken it out and I've put it to work somewhere else. And so I've got really a cost basis of 0 on this company. And I really don't care whether it goes up or down over the next 5 more years. I think it will. And so I don't have to get caught up in the problems of the emotional problems of seeing my stock price going up and down when I'm playing with house money, right? You've taken all the money off the table, you're playing with house money. So that's one of the little tricks we use to control our emotions. So don't probably need to tell you guys how to, what you need to be able to sell a covered call, but if you need 100 shares at least, right, in your account, then you can sell one contract of a call. So you got to own the stock first. What's your obligation when you sell a call? The obligation is to sell your shares to somebody at the strike price if they want them. And so you got to have the shares sitting there as kind of your collateral. And so once they're there, they're not really making any money. You might as well make some money on the shares by selling those calls. And we would call that a Rule 1 call. Okay, so great way to make extra premium, extra profit month to month once you own some shares. So one of the things we like to look for is a nice ceiling, so that when you are looking, you see that Whole Foods, let's say, just bounced off 37 bucks and then started coming down. Well, I could quickly, right there where I see the ceilings holding, sell a call up here somewhere with a pretty good chance of not getting my contract assigned, right? I'm picking up quite a bit of premium because the stock's been coming up, thus increasing those premiums. And as soon as I see, especially here, right, on the second time it's come up and hit that ceiling, I know I have confidence. I don't know, but I have confidence that the stock's probably going to pull back again, not going to break through that ceiling, and therefore I can sell a call up here somewhere and know that it's probably going to expire out of the money. And we love doing that once we have shares. All right, so let me just move on to the last couple slides, and then we'll close her up here for the day. So you've bought, let's say you sold some puts, you got some premiums, and finally, after selling enough puts, after month after month after month, you get assigned, you get some shares, and now the stock starts maybe going up, and now you can start selling some calls. So it's a virtuous cycle, so to speak, of selling puts, selling calls once you own some shares. And we just do it again and again on a particular company that we have a lot of confidence in, like Whole Foods. Because think about what our safety net here is, guys. If the stock keeps dropping, we're okay with that. If Whole Foods goes down to 20 bucks, I'm gonna manage my money in a way that will allow me to get in more and more. 3 or 4 or 5 slices or purchases of stock there of Whole Foods is what I want to do. And so I need it to drop from 29 to 20 in order to get all the shares that I want. And so we are not unhappy when the price drops. It does mess up our rope and rock strategy a little bit, but we know, again, it's a safety net. That safety net says over time the stock's going to go back up and we'll be okay. So here's Whole Foods after 3 years. This is a 3-year chart. You see it came down, bounced, went up, came down, bounce, 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 bounce. Okay, until recently. Then a company came along and started buying lots of shares. And boom, this is pretty much a couple days ago, up goes the stock. In other words, the event, even though the event was basically earnings were going down, has been mitigated at least by just even one company, and the mood changed. All of a sudden, went from fear to greed. And so, like I said, I've been selling calls since it took this big jump up here. I think I have a call at 35, so it could get called away here in a couple months from now, which I'll be okay, right? Because I bought it down here. And or I could just roll out to later months and end up, staying in the stock for maybe years by rolling out and up on my option trade. All right, here's how we can help you guys be better investors. We've got this free blog that people can talk about investing and so on our through our website and what we call the toolbox. And Phil often posts opinions of what's going on out there and throws out ideas. There's a free podcast that just is fantastic. There's over 100 podcasts. Basically, Phil talking to his 30-something daughter, who is a highly educated person, but didn't know anything about money. And so there's a really nice conversation going on between them and these podcasts looking at different aspects of investing. And in fact, it's been so popular that they're turning it into a book. They just got a really good book deal, and they've been working on that book. It should be out next winter, based on somewhat the same concept of dad and daughter talking about money and how to make money and what things to stay away from and so on. So free resources, our calculators and checklists. Again, all of this is kind of on our landing page at our website. And there's a toolbox that we use that I showed you tonight a little bit how to use it. That is I think you get a 30-day free trial on it. So all you have to do is give us your email, and we'll give you the toolbox trial. There's tutorials that you can get on TradeStation and on how to use how to do Rule 1 investing that's in our toolbox. Okay, so once you're in our toolbox, you get some tutorials on how to use TradeStation the way we would recommend it. In other words, how to set up your chart, how to use the tools here on TradeStation, as well as our own tutorials on how to do Rule 1 investing. So those are free there. And last but not least, I'd like to invite you to a workshop that we do. As I mentioned, we were just out in San Diego doing a workshop, and we usually do them in Atlanta. That's where Phil and Melissa, who is our CFO, is Phil's wife, live in just south of Atlanta, just south of the airport. We do it in Peachtree City in a hotel there that is about 30 miles from the airport. So it's a quick get in and get out kind of place. And we do those 3-day workshops. Yeah, I agree, Scott. Nice place. So those 3 days are just power-packed full of knowledge. We're not selling you stuff. It's just we want to teach you what we're doing. And if you've got some experience, you can pick up a ton of good stuff. And if you don't have any experience, you're gonna learn the basics of how to use options, how to do fundamental investing as well. So we're going to teach you how to find wonderful companies quickly and accurately. We're going to show you how to value a company, how to find the best puts and calls to sell on your company. As you can see, we're sellers. We don't do a lot of buying. We're not on the buy side, speculator side. We're on the selling side of things, and that works out very well for us. So we're going to show you how to create cash flow from short-term option trades and know when and where to put your money in a 401k account, because a lot of people have 401k accounts and can't make individual choices about stocks, right? So you can't do kind of what we just talked about today, but there is something you can do that Phil has taught in his books, and we'll teach in the workshop of how to know when to get in or out of the market so you can avoid big drops like we saw in 2008. And then Phil will teach you basically how he went from 1,000 to $1 million in 5 years, actually almost $1.5 million, but he made a commitment to himself to make that $1 million, and he did it in those 5 years. And there's a specific way he started. Obviously, you with $1,000, you can't just double your money every year. That ain't going to work in 5 years, right? So there's some other things you'd have to learn how to do to make that kind of money. So how to apply for the workshop, guys? It's for you from TradeStation, guys, free. Okay, it's going to be a free workshop. All you got to do is get there, and the hotel's a nice place. Bring your spouse, hang out. Know that you're going to work for 3 days. We're going to work you Friday night, Saturday night. You're in there at 9 o'clock Friday morning. We start, and we end at 3 o'clock promptly on Sunday. And we have anywhere from 20 to 30 coaches there to help you, volunteers that have been doing this and making money and just want to help out. So we can really give you guys a great education in those 3 days. So here's your choices: June 23rd to 25th and July 21st to 23rd are the next 2 workshops coming up. As I said, they're in Peachtree City. And you can contact me. This is my email. So if you have any questions about this presentation today or about the workshop that we haven't answered for you, you can go ahead and send me an email and I'll get back to you. So how to apply? It's this, and I don't know how else to do this. Let me see, maybe I can I copy and paste this, or did we put this in? Don, can you put this into the chat box so they could copy and paste it? Because I don't, they're not going to be able to copy and paste it off of the PowerPoint slide. Hey, thanks, Phil. Appreciate your feedback. And Brent, thank you. Susan, thank you. And Chad, very nice, guys. Thanks for your encouragement and support. We want to do everything we can to get everybody as profitable as they possibly can be. And so thanks, James. We are good. I think we're out of here as long as you guys have this slide right here, or this address, so you can go into this landing page we created for you guys. By the way, you got to tell us that you saw this at TradeStation, right? So you do have to tell us where you got this information and got the invitation for the free workshop. So make sure you mention that you saw us on TradeStation. And then there's just a quick little registration process. We'll send the stuff to you to get set up for that workshop, and we'll see you in Peachtree City.